The hard part is you need to execute. And execution starts with having a deep, deep understanding of the problem you're solving, especially around the customers, and making sure, this is important, that the problem you're solving is big enough to matter, is to sit down with customers as early as possible. Speak to them in open-ended dialogue, observe them, understand their pain points, understand the process that they're currently going through. And that's where the inspiration for the best new ventures will come from.
Texas Global, sparking innovative thoughts. Hello, you're listening to the latest episode of Texas Global Podcast, a podcast series by Texas that aims to inspire you with the latest innovation in the world. I am Pupe Chawarat-Yong-Jiranon, a global content editor at Texas and your host. As the world evolves from the COVID-19 pandemic, there is now focus on what is next for venture capitalists or VCs and corporate venture capitalists or CVCs. With us today is Dave Blakely, the Executive Vice President of Mach49, a company that partners with global businesses to build their growth engines through venture capital building, venture investing, strategic partnering, and targeting M&A. It is 100% focused on execution, helping clients disrupt existing markets and creating new ones to drive meaningful growth. He brings to our program today over 30 years of experience creating new ventures at the intersection of emerging technologies, business opportunities, and customer needs to his work. So without further ado, hello, Dave.
Hello, Pupe. It's so good to be here.
Can you tell us more about yourself, over 30 years of experience and how it's been like in the venture capital industry?
Sure. I'm a lucky guy. I've, as you pointed out, it's been, I hate to admit it, it's been 35 years now of watching the incredible Silicon Valley roller coaster and the remarkable ride. In terms of venture capital, I started my career as an engineer and ran a business for a large innovation and design consulting firm called IDEO. But it was about 15 years ago that I first began to make angel investments because I had learned so much about what makes for successful startups in Silicon Valley. I was an angel investor for about 10 years. And what I do for a living now, and what I've been doing for about the last 4 or 5 years, is working at Mach49, helping large companies and all kinds of large organizations to create corporate venture capital arms based on the best practices of venture capitals, and also creating, building, and launching new ventures from within. So that's me.
But there has definitely probably been a lot of things, successes that you've had over the past years. Can you highlight some examples of successful investments that you've made in the past and the reasons behind those successes? And what did you learn from the cases?
Sure. The first thing I'll say is your listeners should always ask angel investors and venture capitalists about their successes, and they should, but the real measure of an investor is to ask about failures and what they learn from failures. And I'd love to take the opportunity to tell you about both. Just, a few of the lessons I've learned putting my money, my savings behind different investments in Silicon Valley is, it sounds like an odd thing, but one thing I've learned as an angel is I only invest in startups that don't actually want my money. So one of the initial investments I made early on was a company called Bebop, and later had a very successful exit to Google. It was started by Diane Green, who also started VMware, which is now worth many tens of billions of dollars. And one of the reasons that I actually took no pay, no salary, and took equity in lieu of salary was because she wasn't eager for investment and she wasn't eager to give up equity. And those are the opportunities that are so valuable. I learned to forgive failure as long as it's appropriate failure, and to continue to back leadership teams even if they've had a failure. So for example, one of the best entrepreneurs I've ever met is a man named Francis Pedraza. I backed his first firm when he had just graduated from Cornell. He made a good run of it, a company called Everest, and they didn't succeed. Everyone's return was exactly negative 100%. But I knew he was a first-rate leader, and so I invested in his next firm, Invisible.tech, which has been extremely successful. So, those are just a couple of examples of lessons learned. And I want to urge everyone listening, whether they're investors or just interested in investing, to be honest and unsentimental about both your successes and your failures.
I have two follow-up questions on that because there are 2 points I find interesting. The one about how you go for those who don't want investment, but how do you convince those owners that to take you on?
Sure. To respond to your first point, if a startup looks very hungry, in the US, as we say, if they're hat in hand looking for investment, you probably don't want to touch them. The best investments don't just want your money. They only want what they would call smart money from angels, or later on money from corporate venture capital groups that can provide something else. So in many cases, I took a seat on an advisory board, or in some cases, I took a seat on the board of directors of the company that I funded because they wanted the benefit of my experience in delivering complex electromechanical systems to market, or they wanted the benefit of my experience in design thinking. So the best investments are the ones in which, because of what you can offer in terms of expertise or other resources or network or supply chain or distribution channel or something, there's something that makes you very special to that startup. And that's the way to get the opportunity to invest in the true tier one startups.
Another thing that's interesting is what you mentioned is that despite a failure of one company, you still kind of followed the entrepreneur to his next business. So what goes behind that decision making? Is it in more of the founders or the business or the product?
So if you get 5 venture capitalists in a room, you'll get 7 opinions about what makes for a winning investment. But what I look for, whether we're talking about seed stage, A round, B round, I'm really looking for 5 things, some qualitative and some quantitative. Now, one thing that has more to do with informed intuition rather than anything tangible, Pupe, is the first attribute I look for, and that's the capability of the team. I want to know, why should I believe in the team and why should I believe in the founding partners? Have they returned money to investors in the past? Are they going to knock down any barriers and just walk through walls and never take no for an answer to deliver their product? So team capability is the first thing I look for. Next, and also when we're working at Mach49, of course, the next thing we look for is the customer desirability around whatever product or service or new line of business people are creating. People often don't ask the question, does anybody want this? I want to understand exactly who the customer is and why they'll choose the offer from this startup more than any other. So you got team capability, you got customer desirability. The next attribute that we always look for at Mach49 is well understood, and that's business feasibility. Is this a large market with the right growth dynamics? Is the entrepreneur clear and believable about how they will make money and exactly what their lucrative and profitable business model is? And then the last 2 attributes we look for are technical feasibility. What is the product? What are the risks? How can those risks be mitigated? And finally, in the case of a corporate venture capital arm, and I understand in Thailand there are a lot of corporate venture capital arms, mothership suitability is the last attribute we look at. Is this the right investment for the mothership, for the corporate venture capital group? Will it help propel forward some of the strategic initiatives of the mothership?
I'm not sure if the next question is similar to what you're answering, but I just want to ask it further because of the fact that, it is very painful to go through failure. And I'm sure a lot of our listeners are trying to navigate and trying to manage risk and diversify their investment portfolio. What is your advice on this aspect?
The first point I want to make is that if you're serious about venture investing, if you're serious about being an angel investor or an A-round investor, you need to think about risk differently from the way big businesses usually think about risk. Look, when I drive over a bridge, when I fly on an airplane to Bangkok, I want the risk of injury or death to be as close to zero as it can possibly be. But too often, big companies thinking about risk apply those same metrics where they somehow believe they can mitigate all the risk out of an early stage investment. I got news for you. You can't do it. You just shouldn't think of it that way. Think of venture investments as occupying a completely different place on the risk reward curve from other investments you might make in, say, a large publicly held company. So look, for risk, what I do see good venture capitalists doing is first, they make sure that their entrepreneurs are themselves understand and are honest about the risks in the businesses that they're setting up. And they make sure that those entrepreneurs are mitigating the biggest risks with the minimum necessary resources. Second, just what you would expect, it's something that is as true in venture investing as in any other type of investing is you need to diversify. You time diversify, investing over 3 to 5 year cycles so that hopefully you're smoothing out these macroeconomic cycles. You get some diversity in stage. You invest in some early stage and some later stage program. You diversify into different sectors, right? Say even within healthcare, you can be in many different sectors across healthcare to reduce risk. It's very important for VCs to reduce risk by investing in additional rounds once they've got some winners. And then finally, VCs diversify by coming up with a large number of investments in the portfolio. Classic portfolio strategy. You would never want to invest heavily and create an entire portfolio with 2 or 3 ventures. If you're being properly aggressive, you're just taking too much risk with your limited partner's money if you do that.
That's very good, very clear in terms of how people, should proceed. Thank you for that. On the other hand, we are in a world that's constantly changing. The world that we live in is not the same as before, like 3 or 4 years ago. What trends or industries do you currently find most interesting or promising for investment?
So the straightforward answer to that question, Pupe, is what emerging technologies do I, as a lifelong technologist, find exciting? And I'll just name a few of those that I think all investors should be watching. First of all, life science, healthcare is due for some incredible revolutions, and I think that the quality of human life and the reduction of suffering is going to be remarkable in the coming years. So I think all investors should take it upon themselves to get familiar with trends like synthetic biology, big data genomics, regenerative medicine, messenger RNA methods, genetic editing tools such as CRISPR, especially for addressing single gene mutation, genetic diseases. These are enormous growth areas. In the physical sciences, no surprise. I mean, everyone is talking about generative AI these days. I've been saying in my keynotes for 12 years, artificial intelligence is going to change everything about the way we live and work and play and communicate and get healthcare and entertain ourselves. I just didn't know when the rapid inflection point was going to happen. It's now. There's no question in my mind that artificial intelligence will completely tear up existing fabrics of business and economy. And when you couple artificial intelligence with the technologies of autonomy, robotic systems that drive, fly, swim, slither, that's amazing. Third big physical science area I'd mention, or rather the second big physical science area that I'd mention is what is generically called Industry 4.0. A manufacturing world and a factory world in which, whether we're talking about refineries or fulfillment warehouses, they will be significantly less dependent on human labor, much more driven by robotic systems, AI, ultimately advanced computing tools like quantum. Let me take a minute and mention a trend or two that I think is overlooked. Something I want to urge all of your listeners to do is ask this question. Ask yourself this every day in business if you're interested in investing. What will historians write about 10 years from now or 20 years from now that is currently being ignored by journalists. And I'll just mention a couple of things. One is China plus one is a very important trend. And the notion of China plus one is very simple. China plus one is the idea that mostly Western European and US-based companies that use China as their manufacturing arms. Think of companies like Apple, for example. They're going to keep those manufacturing lines in China. They're not going anywhere soon, but they are going to duplicate those manufacturing lines in either India, Southeast Asia, and yes, this has huge ramifications for Thailand, or Mexico, or possibly other Central American states. Again, India, Southeast Asia, and Mexico. They will be affected hugely by the China plus one strategy that huge transnationals take as political tensions and supply chain shocks from areas like COVID lockdown continue to lead large product companies to feel less secure about being sole sourced in China. This is not a theory on my part. This is a fact. Apple created a duplicate iPhone 14 line in India. The line delivered iPhone 14s ahead of schedule. That never happens in manufacturing, especially when you're making something as complicated as an iPhone. That's remarkable. The other trend, which you're seeing early stage discussion of, but I think it really bears watching, is a reversal of the 30-year trend towards globalization. And we can all have our own private opinions on that, but it does appear that we're entering a trend in which local and regional businesses will be favored by the fall of what I would call the post-World War II global order of liberal democracies in favor of a multipolar economy. Again, can I point to specific aspects of venture investing that are affected by this? No, but we sure want to keep it in mind.
My mind is blown. I'm so lucky. I feel so lucky talking to you today because everything kind of makes sense. Everything that you're talking about really just falls into place at this time that we're living right now. Whether it is in terms of what you said about the AI, you answered exactly what was in my mind when you were talking about, like, are we actually at that pivotal point? And yeah, it is. And at the same time, China's role in the global economy has definitely changed. And it's interesting how, the manufacturing trends are changing as well. On the other hand, what about VCs? In the midst of all of this, VCs still have to be attractive. How can VCs attract itself or differentiate itself from other funds to attract limited partnerships or LPs?
Humility and an understanding of what makes you special. Just having capital, being, to put it bluntly, dumb money is never going to get you anywhere. It is never going to get you those tier one investments. Like I said earlier, Pupe, tier one startups, the type of startups we all want to invest in, don't want your money. They want your money plus something else. They want your expertise. They want business introductions you can make. They want your they want your skills in running an operation. They want your skills in expanding a business. They want your support. And in addition to those things, they would love to take capital from you. Liquidity, even in a down period in our global economy, remains abundant. I am very, very proud of the work that Mach49 has done with TDK Ventures. The man who runs TDK Ventures, Nicolas Sauvage, what he calls it is the TDK goodness. TDK is a first-rate global manufacturer of advanced sensing and actuation products, and they've got that deep expertise. And so the man who runs their venture fund, whose name is Nicolas Sauvage, told me that he sees the early successes that led to TDK to quadruple its assets under management to 200 million come directly from the TDK goodness, this deep, deep knowledge they have of advanced electronics. Similarly, VCs can differentiate themselves through clarity of purpose. You need to know why you're investing. For most corporate venture capital groups, it's not just about maximizing return for limited partners. It's also about advancing your strategic initiatives. So, another one of the corporate venture capital groups that we've built, this one for Goodyear, the auto tire company, the CEO, Rich Kramer, said a while back, we're looking for partnerships that can help us imagine or redefine new business models. Well, that's really beautifully stated. That's clarity of purpose. And so he's not just looking for a nice return from his venture investments. He's looking to redefine business models, to create entirely new services, and to understand what is necessary in an entirely new era of mobility.
At the same time, you do have that situation where I just mentioned, the changing of the environment that we're living in. In your expertise, you've been doing this for over 3 decades, right? We have economic downturns. What is your advice for, limited partnerships and general partners, when it's faced with a downturn? Because each downturn is very different, right?
Each downturn is very different, but every time there's a downturn, it's always the same story. People say, things are different from now on. Entrepreneurship's never going to be the same. Again, I think it's very important to be honest and unsentimental about where you were wrong. I think it's important to admit where you were wrong. I was incredibly wrong during the first major downturn that I experienced as a professional, which was in 1999. I was living in Mountain View and I was working in Palo Alto. I was at the epicenter of the dot-com bust, right? One day, you couldn't get a parking spot or a restaurant reservation in San Francisco. And the next day, you couldn't rent a U-Haul truck because everybody was moving out. It was absolutely crazy. I confidently told people that I felt that venture capitalists had retrenched, that there weren't really any entrepreneurs doing anything remarkable. And I was just completely dead wrong. Even quietly, all through 99, amazing innovations were happening. And so people were saying the same thing 8 years later in 2008, when we had this big global, in the US at least, we had this huge meltdown from real estate. But I knew that despite the economic doldrums, amazing innovation was happening. And, sure enough, what was happening during this incredible market crash in 2008? Apple was launching the iPhone. Twitter went global. Facebook went global. Android was released. Airbnb was founded. IBM created Watson and later won at Jeopardy. Hydraulic fracturing started in the oil and gas industry. I'm a technologist. I could go on about this all day. But the point is, 2008 was full of naysayers. 2008 was full of people saying, well, there's no real action in venture capital, in innovation. Everybody's just doing incremental stuff. People are saying the same things now as we see the after effect of the global supply shock, the after effects of COVID, the challenges of high inflation, uncertainty over climate change, and so on. I don't accept it. I can't tell you what's going to be huge, but right now, all over the world, in Tel Aviv and Shenzhen, and Dubai, there are amazing Cambridge, Silicon Valley, of course, there are amazing innovations happening. I just know it.
The thing is that things are so quiet in our side of the world in Southeast Asia at this time.
Yes.
But yeah, you can't deny that there is innovation. You just talked about it, right? It's ongoing. But at the same time, there is that kind of a sense of a worry of, are we going to go back to those golden years before the pandemic when everything was kind of just so shiny? Or is it going to be a different world?
And look, things are quieter. If you didn't think things were quieter, you just aren't reading the papers, right? So on one hand, there are somewhat fewer people starting startups. There's little less investment happening from large companies. But the flip side of that is that the deal-making environment for investors is now becoming more investor-friendly. You look at so many different metrics, like liquidation preference, the order and amount that VCs get paid in the event of an exit. Those are extraordinarily better today than they were 2 or 3 years ago because things have slowed down and VCs can get better investment terms.
Yeah. So then when you take a look at the market itself, how do you assess the market potential and scalability of a startup then before making an investment decision?
Sure. So the answer to that question, when I'm assessing the scalability of a startup, it depends on the stage the startup is in. But the first thing I want to say is that, remember, we're operating way out on the risk reward curve, right? I'm not worried about losing 10% of my investment. I'm worried about losing the entire thing. So in order to justify that risk, the first thing I want to see if I'm investing is I want to see a path for this startup to completely dominate their target market. Okay. I want them to be the undisputed champion of their target market. For example, I was a very early investor in a company called Mindtribe that had a very specific and very unique skill. Agile methods, agile development was built for software, and Mindtribe was a startup that applied agile methods to complex hardware systems, complex hardware electromechanical systems. I knew that they could dominate the market. So did Accenture, and that's why Accenture bought them about 5 or 6 years after I invested. So first, do I see a path for this entity to dominate the market, no matter where they are? Now, when you're in seed round, you don't have a lot of evidence to go by. Sometimes people have preliminary non-paying beta clients. Often they don't even have that in seed round. So what I'm looking for in seed is I'm looking for an innovative idea. I'm looking for a very big market with the right growth dynamics. I'm looking for a profitable business model. I'm looking for a competitive landscape that's got some gaps in it that will let the startup in. And I'm looking for a startup that fits with some of the major megatrends that I mentioned a little earlier. Someone who's going to ride the wave of Industry 4.0 in factories, or ride the wave of advanced autonomy that will be enabled by artificial intelligence. So that's for seed. And then for A round, I'm looking for all of that. But these days, for digital companies, digital systems can be put together so quickly that I'm looking for a pretty significant customer base, and I'm looking for an ARR, an annual recurring revenue, of at least $1 million by the time we get to A round. I want to see a company that's making good revenue, that's on a rapid growth curve, and is targeting profitability. Yeah. Some of the startups I invest in are hardware companies. Their development by its nature is slower. Medical instruments and devices, consumer electronics, and so on. With such companies in A round, I'm not looking for paying customers. That's a little too early. But what I am looking for is promising technical test results, say for this advanced cholesterol test or whatever they're making. And B, I'm looking for at least a memorandum of understanding, an MOU, from certain key customers, whereby if the startup meets certain standards of performance, they'll buy.
Mm-hmm. So with that, to dive deeper a little bit, what factors do you consider when determining the valuation of a startup during the investment process?
Yeah, this is a craft rather than a science. Let me start by telling you what I would never use. The methods of valuation of a new opportunity that many people learn in business school and that are conventionally applied in businesses that are making incremental advances. One of them is called net present value analysis, or NPV analysis, and the other is called discounted cash flow. Those are classic ways to value investments with solid and predictable returns. They're sometimes misapplied to startups. Those methods, like discounted cash flow and net present value analysis, simply do not apply to startups. It's challenging, but the best way to understand the value of a startup is by looking at a combination of the quality of the team, right? The capability and the caliber of the founding team, coupled by your best estimates of, the revenue set against the cost. How do I know that a revenue plan from a startup is critical? I really look for startups that go at their revenue plans in two ways. First, they do a top-down analysis. They might do the total addressable they might do this, the total addressable market, the serviceable addressable market, the serviceable attainable market. They would essentially start top down, looking at the total addressable market, they would argue convincingly to me that they can grab a fraction of that. They might be able to grab 3% or 5% of the total addressable market. Credible companies, credible startups also estimate their revenue from the bottom up, looking at who their initial customers might be, how rapidly they can grow their customer base, and what comparable companies have done. If I see both of those methods of analysis done, and I have some roughly believable revenue and cost projections, that coupled with the quality of the founding team are the two most powerful tools for me to work out the valuation of a company.
I'm going to jump to one of the option questions that we had for you, because I think it's really related, and that is the key metrics or the milestones. What do you expect to see in a startup before making an investment decision?
Yeah, let's go back to these 4 mix of qualitative and quantitative metrics. Okay, now your listeners can look up, for example, good metrics for a SaaS product. Right? It's well understood. The cost of customer acquisition and the churn rate and things like that. Those things are pretty well understood, and there are some conventional metrics. I think the metrics that people often overlook in making an investment decision are the ones that straddle qualitative and quantitative issues. Right? Your customer. Can you demonstrate a pain? Do you have the customer insights that are the basic currency of credibility? And even if you've only talked to a small number of people, do you have qualitative evidence that people are really feeling a significant, a widespread and acute pain and are interested in your product? That's a qualitative metric. But if you can demonstrate to me, for example, that you've talked to 30 different people about the need for improved travel services, or the need for a better understanding of maintenance intervals for your manufacturing equipment, or whatever it is, if you've talked to 30 or so diverse people and you have verbatim quotes from them, and many of them are experiencing the same pain, you're getting my attention. So that's a first qualitative metric, customer desirability. Again, the second one, like we talked about, business viability, market size, market dynamics. I'm looking for a massive market. I'm looking for a market potential in the billions in the long term, even though I recognize that it takes startups a long time to get there. And I'm looking for a highly lucrative business model. And then third, probably the most quantifiable of all, is technical feasibility. For example, I want to make sure that there aren't external dependencies. For example, regulatory approvals that will take a long time, or infrastructure for electric cars that hasn't been built yet, something like that. I also want to make sure that that any advanced technology is well understood and at a high technology readiness level. So I hope that helps a bit with some of the sort of hybrid qualitative quantitative metrics that I and that Mach49 uses to help inform investment decisions.
So then, when you go to the stage of exit, right? How do you typically exit investments, and what is your preferred exit strategy?
I would challenge anyone to name the best exit strategy. The exit strategy is highly individual to the organization itself. In some cases, an IPO, which people feel like that should be the goal of all entrepreneurs, but I don't agree. For some fraction of the cases, money from the public markets is a really good exit strategy, and at that point, I would exit. For others, a merger and an acquisition with the right buyer, someone who understands both cultural and financial and technical issues when they make the acquisition, is suitable. There's some is suitable that I've seen, which after taking funding, just continue to grow organically at a tremendous rate. They don't need money from private equity players or from the public markets. That's another possible exit, is the illiquid privately held valuation of the company increasing rapidly year on year.
Now, let's head to the perspective of, entrepreneurs. What are the common mistakes or pitfalls that entrepreneurs, that you see that, they should avoid during the fundraising process?
Yes, yes. We could talk all day about this, but I'm just going to name three. The first is what I like to call tech push. Tech push is the idea that some technology that you've developed is so elegant that it will sell itself. And I know it sounds naive, but a lot of startup entrepreneurs believe that. The winners at this game create a healthy tension between technology push and market pull. So they have a deep understanding of what people actually need. They have a deep understanding of widespread user needs, and broad business opportunities. And they also have a strong sense of the possibilities of a given technology that they've either adopted or developed. So beware just tech push. Beware feeling like if you build something, the customers will come by magic. Create it, make it clear to your investors that you've created a healthy tension. You understand both how to push the technology into the market and also how to generate demand or market pull. Next thing I'll say is a piece of advice number 2 is clarity of communication. First of all, if you're in a pitch day, if somebody asks you a question or think of investing, answer the question. Don't sit there and sell and say a bunch of irrelevant things. If I ask you a question, answer my question. Second, make sure that when you're presenting your idea, make sure that what you're presenting is you're presenting a picture where you're describing to me exactly what it is you're building. I know this sounds goofy, but there are so many wannabe entrepreneurs and budding entrepreneurs that describe their product or service by virtue of its attributes. They say, well, this is transparent and it's trustworthy and it's cloud-based. And I find myself asking, but what is it? What the heck are you making? So if my first piece of advice is beware of tech push, and my second 2 pieces of advice are tell me what you're making straight up and answer my questions. The third thing I would say is be judicious about your investors, right? It's so thrilling when you have someone who's willing to invest, particularly a lead investor, that it's hard to be cautious. But again, quoting this man, Nicolas Savage, who I think is such a savvy manager of TDK Ventures, what he said is venture capital is really about 2 things. He says it's about deal making and it's about deal flow and it's about decision making. And for example, he acknowledges that generally speaking, corporate venture capital groups, at least, have poor deal flow and their decision making is weak and inconsistent and ineffective. Don't sign up with someone like that, right? Be cautious. Listen to Nicola's words of caution about the quality, and he's talking particularly about corporate venture capitalists here, and make sure that just as the investors are assessing you, you are assessing them, and you're making the best choice for yourself.
It's as if like it's so clear, but sometimes it's just so hard for people to realize that they. If you can correct me, but I feel like from listening to you, it's like you really have to know yourself. You
Yes.
really have to be grounded and know yourself, right? And be clear, which is hard. People get excited.
You really do need to know yourself. And I'll tell you something else you need to know, another way in which you need to know yourself. Show me a good team of venture capitalists, and I'll show you people who hold each other to account around cognitive biases. We all have certain fundamental biases, like, selection bias, where I choose the facts that support my investment thesis and ignore those that don't, right? And if you show me a good team of venture capitalists, I'll show you people that challenge each other's natural cognitive bias and challenge each other to make the best, most rational decision about investments.
Okay. And lastly, you've been so generous, by the way. Thank you so much for giving us a lot of insight.
It's a pleasure.
To wrap things up, what is your advice that you want to give to entrepreneurs seeking funding for their startup? There's a lot of things that you've mentioned, but if they could just take away one thing from our conversation today, what should they think about?
Sure. If there's one thing for your entrepreneurs or your investors to think about, they should take a page from the playbook of a woman named Erin Spring. I'm actually looking forward to having a fireside chat with her at a conference in about a month. Erin is the new ventures director for Goodyear and has run a very, very has helped with some very successful venture work. And as Erin puts it, coming up with ideas is the easy part. Don't kid yourself that once you have that $1 million idea, you just laugh them all the way to the bank. All investors will tell you, good ideas are a dime a dozen. As Erin puts it, the hard part is you need to execute. And execution starts with having a deep, deep understanding of the problem you're solving, especially around the customers, and making sure, this is important, that the problem you're solving is big enough to matter. And the single best advice I can give you to make sure that you're figuring out whether what you're solving really matters and is really big is to sit down with customers as early as possible. Speak to them in open-ended dialogue, park your agenda outside the door, observe them, understand their pain points, understand the process that they're currently going through. And that's where the inspiration for the best new ventures will come from.
Wow. Thank you so much, Dave, for being with us here today. To say being generous, I think is overstating it. Understating what I'm feeling right now, because I think a lot of people have benefited from our conversation in terms of what are the trends to think about and what are the main core things that both investors, VCs need to think about, as well as entrepreneurs. And for our listeners, if you want to listen to more insightful conversations such as this one, you can check out our TechSauce Global podcast episodes at techsauce.co/en. See you next time. Sawasdee ka.
TechSauce, sparking innovative thoughts.